Ladies and gentlemen, today I want to draw your attention to a signal that many are ignoring but few can afford to dismiss. Beneath the daily headlines and market noise, an important warning is beginning to take shape in the silver market. History teaches us that the greatest financial surprises often emerge when confidence is highest and vigilance is lowest. The question is not whether change is coming, but whether investors are prepared to recognize it before the crowd does. What we discuss today could prove far more significant than many realize. A major warning signal is emerging beneath the surface of the silver market, and what makes it significant is not what everyone can see, but what very few are paying attention to. Markets rarely announce turning points with certainty. Instead, they whisper before they speak and speak before they shout. Today, silver appears to be sending one of those signals. While many investors remain focused on daily price fluctuations, the more important story is unfolding in the background where liquidity, capital allocation, monetary expectations, and investor psychology are beginning to shift. High alert should be directed not toward the headlines of the day, but toward the underlying forces that often precede substantial market adjustments. Throughout financial history, periods of apparent calm have frequently concealed growing tensions beneath the surface. The greatest risks rarely emerge from what investors fear most. They emerge from what investors have stopped questioning. That is why this moment deserves careful attention. Silver holders should recognize that markets can remain comfortable for extended periods and then change direction with surprising speed. When expectations become widely accepted, when confidence becomes excessive, and when investors begin treating recent trends as permanent realities, the foundation for unexpected outcomes is often being laid. High alert should placed on complacency. Complacency has a remarkable ability to convince intelligent people that conditions are stable precisely when they are becoming less stable. We are operating in a global environment characterized by elevated uncertainty, shifting economic priorities, evolving policy debates, and growing questions about the future path of growth and inflation. These developments do not always produce immediate reactions, but they create conditions in which asset prices can become increasingly sensitive to new information. Silver, because of its unique position between an industrial commodity and a monetary asset, often finds itself at the center of these transitions. Investors who focus only on short-term movements may miss the larger message. High alert should also be directed toward changing market narratives. Narratives can be powerful drivers of investment decisions, but they can change quickly when facts begin to challenge assumptions. Markets are forward-looking mechanisms. They constantly reassess probabilities, expectations, and risks. When those assessments begin to change, capital can move rapidly from one area to another. The warning today is not necessarily that a specific outcome is guaranteed. The warning is that the range of possible outcomes may be widening. In such an environment, confidence should be accompanied by humility. Conviction should be balanced by preparation. The investors who perform best during periods of transition are rarely those who make the boldest predictions. They are the ones who remain attentive when others become distracted. High alert means understanding that risk is not simply the possibility of loss. Risk is the possibility that the future unfolds differently than expected. Silver holders should therefore ask themselves an important question. Are decisions being driven by careful analysis of evolving conditions, or are they being driven by assumptions formed in a different environment? The distinction matters. Markets reward adaptability more often than certainty. They reward discipline more often than emotion, and they reward those who recognize early signals before they become obvious to everyone else. The message emerging today is straightforward. Pay attention, remain vigilant, challenge assumptions, and respect the possibility that important changes may already be underway, because when markets finally react to warnings that have been building quietly beneath the surface, the opportunity to prepare is often gone, and the investors who were paying attention are already several steps ahead. One of the most dangerous conditions in any financial market is not panic, uncertainty, or volatility. It is complacency. Markets have an extraordinary ability to make investors comfortable at precisely the wrong moment. When prices appear stable, when familiar narratives dominate conversations, and when recent experience begins to feel permanent, a subtle but significant risk starts to emerge. A high alert warning should be directed toward this very condition. Throughout history, major market shifts have rarely occurred when investors were expecting them. They have often occurred when confidence was widespread and caution was viewed as unnecessary. The challenge for silver holders today is not simply understanding where prices are. The challenge is understanding whether current assumptions accurately reflect the realities that are developing beneath the surface. Markets are forward-looking mechanisms. They do not wait for certainty. They move in anticipation of change. By the time evidence becomes obvious to everyone, opportunities have often diminished, and risks have already been repriced. That is why a high-alert perspective matters now more than ever. The greatest financial mistakes are often made not because investors lack intelligence, but because they become overly comfortable with prevailing conditions. Familiarity creates confidence, and confidence can gradually evolve into complacency, When that happens, important signals are overlooked. Investors stop asking difficult questions. They stop challenging assumptions. They begin to interpret new information through old frameworks. Yet the economic environment is constantly changing. Capital flows change, monetary conditions change, global priorities change, investor sentiment changes. Silver, like many strategic assets, responds to these developments in ways that are not always immediately visible. A high-alert mindset recognizes that markets are dynamic rather than static. It recognizes that yesterday's conclusions may not be sufficient for tomorrow's challenges. What deserves particular attention today is the growing tendency among market participants to focus on short-term fluctuations while ignoring longer-term structural developments. Daily price movements attract headlines. Temporary rallies and pullbacks dominate discussions. But significant market turning points are rarely defined by a single day or a single event. They are usually the result of forces that build gradually over time before eventually becoming impossible to ignore. This is where complacency becomes especially dangerous. When investors become preoccupied with immediate outcomes, they often fail to recognize larger trends that are quietly gaining momentum. A high alert signal means stepping back from the noise and examining the broader landscape with discipline and objectivity. Another reason for caution is that markets often reward consensus for a period of time before abruptly challenging it. When most participants share similar expectations, the market becomes vulnerable to surprises, not because those expectations are irrational, but because they become deeply embedded in decision-making. The more widely accepted a belief becomes, the greater the potential impact when reality diverges from that belief. Silver holders should understand that risk is not always visible. Sometimes risk exists in the assumptions that are rarely questioned. Sometimes, risk exists in confidence levels that become disconnected from uncertainty. A high-alert approach requires investors to remain intellectually flexible even when they feel confident in their outlook. Periods of transition often begin quietly. They do not arrive with dramatic announcements or unmistakable signals. Instead, they emerge gradually through subtle shifts in behavior, expectations, and market positioning. Investors who remain attentive during these periods are often able to adapt more effectively than those who assume current conditions will continue indefinitely. The objective is not to predict every outcome. Objective is to recognize that the future is inherently uncertain and that preparation is more valuable than prediction. Markets respect discipline. They reward patience. They favor those who maintain perspective when emotions become dominant. The warning for silver holders is therefore straightforward. High alert should not be interpreted as fear. It should be interpreted as awareness. Awareness that conditions are evolving, awareness that consensus views can change, awareness that complacency has historically preceded many of the most significant market adjustments. Investors who remain curious, vigilant, and willing to reassess their assumptions place themselves in a stronger position regardless of what comes next. Because in financial markets, the greatest advantage often belongs not to those who react first, but to those who are paying attention before everyone else realized that conditions had changed. Economic shifts, policy uncertainty, and changing capital flows are beginning to reshape the landscape for silver holders in ways that deserve a high alert level of attention. Markets do not operate in isolation. They are influenced by a complex interaction of economic growth, inflation expectations, interest rate assumptions, fiscal decisions, geopolitical developments, and investor behavior. When several of these forces begin moving simultaneously, the implications can be far greater than many participants initially recognize. What makes the current environment particularly important is not the existence of uncertainty itself. Uncertainty is always present. What matters is that uncertainty is becoming increasingly difficult to measure. And when that occurs, markets often experience periods of adjustment that are larger and faster than expected. Silver holders should understand that significant market changes rarely begin with dramatic headlines. They often begin with subtle shifts in expectations. A high-alert perspective requires investors to focus not only on what is happening today, but also on what may be developing beneath the surface. One of the most important developments in any market cycle is the movement of capital. Capital is constantly searching for opportunities, stability, and value. When investors gain confidence in one area, resources flow toward it. These shifts can occur gradually at first and then accelerate unexpectedly. Silver has historically responded to these changing flows because it occupies a unique position within the financial system. It is influenced by industrial demand, monetary expectations, investment sentiment, and broader macroeconomic trends. This means that silver often reflects not one story, but many stories unfolding simultaneously. A high alert signal emerges when these stories begin to point in different directions, or when investors become too focused on one narrative while ignoring others. Policy uncertainty adds another layer of complexity. Markets spend enormous amounts of time attempting to anticipate future policy decisions. Investors evaluate what central banks might do, how governments may respond to economic challenges, and what new regulations or fiscal measures could mean for growth and inflation. Yet the reality is that policy outcomes are rarely known with certainty. Expectations can shift rapidly. What appears predictable one month may look entirely different the next. This is especially important because markets frequently react not to actual events, but to changing expectations about future events. A high-alert approach recognizes that even modest adjustments in policy expectations can influence asset prices, investor confidence, and capital allocation decisions across global markets. Another factor demanding attention is the growing possibility that economic conditions may not evolve in a straight line. Investors often prefer clear narratives. They want definitive answers regarding growth, inflation, interest rates, and market direction. Unfortunately, economic systems rarely provide such clarity. Economic data can send conflicting signals. Growth may appear resilient while underlying weaknesses begin to emerge. Inflation may decline temporarily while long-term pressures remain unresolved. Financial conditions may appear stable while vulnerabilities quietly accumulate. Silver holders should understand that markets often struggle most during periods when traditional assumptions become less reliable. A high-alert mindset means remaining open to multiple possibilities rather than becoming attached to a single forecast. The relationship between confidence and risk also deserves careful consideration. Strong market sentiment can create opportunities, but it can also encourage investors to underestimate uncertainty. When confidence becomes widespread, risk assessments often become more relaxed. Investors begin assuming that recent trends will continue. They become less sensitive to warning signs. They place greater emphasis on favorable outcomes and less emphasis on alternative scenarios. History suggests that such periods frequently precede important adjustments. The warning is not that a crisis is inevitable. The warning is that markets become vulnerable when confidence rises faster than understanding. A high-alert perspective requires maintaining discipline even when prevailing sentiment encourages comfort. Perhaps the most important lesson for silver holders is that economic transitions rarely announce themselves in advance. They develop through a series of interconnected changes that appear manageable individually but become significant collectively. Capital flows shift, expectations evolve, policy assumptions change, investor behavior adapts. Each development may seem modest on its own, yet together they can alter the trajectory of markets in meaningful ways. Those who remain attentive during these periods are often better positioned to navigate uncertainty than those who rely exclusively on past experience. The message today is simple but important. High alert is not about predicting disaster. It is about recognizing that the landscape is changing, that assumptions deserve reevaluation, and that successful investors are often those who identify evolving conditions before they become obvious to the broader market. Markets are entering a period in which economic shifts, policy uncertainty, and changing capital flows deserve a high alert level of attention from every silver holder. The reason is straightforward. Financial markets are not driven solely by current conditions. They are driven by expectations about future conditions. Investors spend enormous amounts of time evaluating what they believe will happen next. They attempt to anticipate economic growth, inflation trends, monetary policy decisions, and the movement of capital across global markets. Yet the most consequential changes often occur when those expectations begin to diverge from reality. This is where significant opportunities and significant risks emerge. The warning signal today is not necessarily about a single event or a policy decision. It is about a broader transition taking place beneath the surface of the financial system. A high-alert perspective recognizes that periods of transition can alter market dynamics far more quickly than many investors anticipate. Economic conditions around the world are becoming increasingly complex. Growth remains uneven across regions. Some sectors continue to demonstrate resilience while others face mounting pressure. Inflation concerns that once appeared temporary have evolved into longer-term considerations. Interest rate expectations remain fluid. Governments continue to confront difficult choices regarding spending, debt, taxation, and economic support measures. None of these developments operate independently. They influence one another in ways that can reshape investor sentiment and market behavior. Silver holders should understand that assets often react not only to economic outcomes, but also to changing expectations surrounding those outcomes. A high alert signal emerges when uncertainty surrounding the future begins to expand rather than contract. Capital flows represent another critical area of focus. Capital is constantly moving throughout the global economy in search of security, opportunity, and return. These flows influence asset prices, currency valuations, investment demand, and market sentiment. What appears stable today can change rapidly when large pools of capital begin repositioning themselves. History demonstrates that major market moves often occur when investors collectively reassess where they believe value and protection can be found. Silver has frequently attracted attention during such periods because it occupies a distinctive position within financial markets. It is influenced by industrial demand, monetary considerations, investment flows, and broader economic expectations. This combination means that silver often responds to developments occurring across multiple areas simultaneously. A high-alert mindset requires understanding these interconnected forces rather than viewing silver through a single lens. Policy uncertainty adds further complexity to the landscape. Financial markets continually attempt to anticipate future decisions from policymakers. Investors evaluate statements, projections, economic data, and policy signals in an effort to estimate future outcomes. Yet policy paths are rarely linear. Conditions change, priorities evolve, unexpected developments emerge. Decisions that appear certain today may look very different 6 months from now. Markets understand this reality, which is why expectations often fluctuate long before actual policy changes occur. Silver holders should recognize that markets are highly sensitive to shifts in expectations because expectations influence investment decisions before policies are fully implemented. A high-alert perspective acknowledges that uncertainty surrounding future policy actions can become a powerful market force in its own right. Another important consideration is the relationship between confidence and vulnerability. Strong confidence can support markets for extended periods. However, confidence can also create blind spots. Investors sometimes become so comfortable with prevailing narratives that they stop examining alternative possibilities. They begin assuming that current trends will continue indefinitely. They become less attentive to emerging risks. Yet history repeatedly demonstrates that market conditions can change when confidence reaches its highest levels. A high alert signal is not a call for fear. It is a reminder that confidence should be balanced with vigilance. Successful investors understand that preparation is often more valuable than prediction. Silver holders should also pay attention to the possibility that future developments may not align with current consensus expectations. Consensus views are useful because they provide a framework for understanding market sentiment. However, consensus can also create vulnerability when too many participants become positioned for the same outcome. Markets are most sensitive when reality begins moving in a direction that differs from prevailing expectations. This is often where volatility emerges and where major repricing events begin. A high-alert mindset means remaining flexible enough to recognize when conditions are changing, rather than becoming anchored to outdated assumptions. The broader message is clear. Economic shifts, evolving policy expectations, and changing capital flows are creating a landscape that deserves close attention. The objective is not to predict every development or forecast every market movement. The objective is to remain aware that the environment is changing. Investors who maintain discipline, challenge assumptions, and stay focused on underlying trends are often better prepared than those who rely solely on recent experience. High alert means recognizing that important transitions are frequently visible long before they become obvious, and those who identify them early often possess the greatest advantage when markets begin adjusting to a new reality. Every market cycle rewards those who see clearly when others are distracted. The warning now facing silver holders is not merely about price movements, it is about understanding the forces that are quietly reshaping the financial landscape. The coming months may test assumptions, challenge expectations, and separate conviction from speculation. Those who remain informed, disciplined, and forward-looking will be best positioned for what lies ahead. The biggest risk is not the warning itself, it is choosing to ignore it.